This is your Wall Street wake-up call. The economy creating 151,000 jobs in August, missing estimates of 175,000. With me now to discuss is David Nelson, the chief strategist at Bell Point Asset Management, and John Lonsky, the chief capital markets economist at Moody's Analytics. So David, let me start with you. 151,000 jobs, a significant slowdown from the past couple months.
July was revised higher, so that was one bright spot, but it's pretty clear that September's off the table. At least in my opinion, I think the Fed missed their window as far back as 2013. They could have been rising into a 4% GDP. You don't have those conditions right now. You add the election right now, that dynamic. They're not going to hike in September and probably not till the end of the year.
And John, do you agree with that? I mean, the unemployment rate held steady at 4.9%. We actually wanted to see that go up a little bit because it would have meant that more people are entering the workforce.
It's not happening. You know, David's right. There's only a 12% probability of a rate hike in September. And I think of special importance is the fact that only 126,000 jobs were created in the private sector. And given the fact that we had an across-the-board reduction as far as payrolls in goods-producing sectors are concerned, my impression is that jobs growth was concentrated among lower-quality jobs, you know, leisure and hospitality, hospitals and the like, retailing.
Although we should point out that in the July report, the three-month average of job creation was 190,000. Now it was ratcheted up to 232,000.
Yeah, that's around the margin right there. But if you look right now, the dynamic right now, the economy is kind of muddling along. Yesterday's PMI, that was kind of a disappointment. It's odd that they wanted to be in a hiking cycle given the dynamic right now. I think all they're trying to do is create some kind of buffer zone that they have, so they can accommodate at some point in the future if and when we get to a recession.
The Fed.
The Fed, absolutely.
And John, wages were very weak this month.
Yeah, they're up by only 0.1% for the month. They're up by less than 2.5% from a year ago. By no means do we have an acceleration of wages underway that threatens to add measurably to inflation risk.
And David, just going back to the Fed for a moment, I mean, the Fed has its meeting in September, but September and October are normally volatile months for the market. So does the Fed want to move in September when, knowing how fragile the markets are?
I think it's less about that. I actually think it's the political dynamic. I don't think they want to be seen as political. I don't think they want to do anything that would, push the election one way or the other. We know that the markets are going to be pretty volatile, whatever they do. And now it comes to December, and that could be pretty dicey because last December when they hiked, we really tanked in January.
Here's the bottom line. I think the job reports of the two previous months, July and June, vastly overstated the underlying health of the labor market, largely because we had payrolls on a year-over-year basis growing more rapidly than real GDP. That makes no sense. Growing more rapidly than corporate revenues doesn't make any sense. Growing faster than hours of work, forget about it. So that 151,000 new jobs created in the month of August is very much the sign of things to come.
I think the weak earnings that we're seeing, that backdrop, and some of the other economic data, that's probably more the real health of the economy. I think John's right. I think the jobs numbers we're getting are really overstating the health of the economy.
Okay, so with this delayed rate hike, assuming you guys are right that the Fed doesn't move in September, is that good for stocks with the exception of banking stocks?
It's going to be good for stocks, but like you said, I think the banking sector is probably at risk today. That's really run in the last month in anticipation of a rate hike. I would expect most of that sector to be down today. We'll find out.
John?
Yeah, David's right, but every time the equity market gets carried away on the upside, you can be sure that some high-ranking Fed official is going to come out and give that warning that a rate hike is inevitable.
John is absolutely
the brushback
right
pitch
there.
is coming.
I'm right there.
Because they clearly have so much credibility.
You're going to see a parade of governors come out over the next week to confuse us. A whole bunch of different rhetoric.
Well, we thank you guys for joining us to help breaking everything
My pleasure.
down. Thank you. I'm Scott Gamm, and you're watching The Street.